Hey everyone, welcome back to Corporate Decoder, the place where we untangle the suit's secrets and find the real story behind the numbers. Today we're diving into Jupiter Neurosciences, Inc., and a report that might just be a game changer or something else entirely. Stick around to find out. Before we dive into the nitty-gritty, if you are all about getting clear, nonsense insights from the world of corporate filings, hit that subscribe button, and hey, we've got a fantastic community discussing these very topics over on our Discord. Link is in the description below, come say hi. So, what is going on with Jupiter Neurosciences Inc. here? This filing is all about an important agreement they've entered into, and it seems like they are leaning pretty heavily on selling their stock to raise funds. The big news is they've got this standby equity purchase agreement, or SEPA for short, with a company called Yah the Second Ltd, also known as Yorkville. Think of it like a flexible credit line, but instead of borrowing money, they can choose to sell their stock to Yorkville at market prices when they need the cash. They've already used this a couple of times, and a recent transaction happened around the end of 2025 to get them more funding. Now, this isn't a simple stock sale. When the company sells stock under this agreement, it is tied to something called convertible promissory notes. This is a bit of a fancy term, but basically it means Yorkville is giving the company money now, and in return, the company is promising to give Yorkville either shares of stock or the option to convert that money into shares later. It's a way to secure funding without a fixed interest rate like a traditional loan. They've had two of these transactions, and the latest one, around December 2025, brought in a significant chunk of change. Specifically, on the 23rd of December 2025, the company received another $1,860,000 from Yorkville. This was after getting approval from their shareholders to issue more stock than they normally would be allowed to, which is a pretty big deal for a public company. Selling stock like this, especially when you're issuing a lot of it, can sometimes make things a bit tricky for existing shareholders because it can dilute their ownership. But for Jupiter Neurosciences, it seems like they needed this capital to keep things moving. So Jupiter Neurosciences is identifying itself as an emerging growth company. What does that mean for us? It means they get a little bit of leeway with some of the financial reporting rules, and they can choose to delay adopting new accounting standards. This is common for newer companies trying to grow and manage their finances without being immediately burdened by all the latest regulations. The way they are selling these shares to Yorkville is through what is called an exemption from registration. This means they are not going through the full, lengthy process of registering every single share with the Securities and Exchange Commission, or SEC. They are relying on a section of the law that allows for sales to specific types of investors, like accredited investors who are presumed to be sophisticated enough to understand the risks involved. Yorkville has represented that they are indeed an accredited investor. Looking at the exhibits referenced, the company has provided forms for these convertible promissory notes. It's good they are being transparent about the instruments, but the actual details of these notes are incorporated from previous filings. This means to get the full picture, you'd have to go back and read those earlier reports too, which can be a bit of a treasure hunt. There was also an amendment to the main standby equity purchase agreement on the 19th of November. Amendments are common and usually tweak terms or clarify things. This shows the agreement is a living document that the parties are actively managing. And finally, looking at the signatures, Krista Rosen, Chairman and Chief Executive Officer, has signed off on this report. This signifies the top leadership is aware of and attesting to the contents of this filing. Now, let's talk about what this all means for Jupiter Neurosciences. This standby equity purchase agreement is a double-edged sword. On one hand, it provides a flexible way to raise capital as needed, which can be crucial for a company in the biotech or pharmaceutical space, where research, development, and clinical trials are incredibly expensive and often unpredictable. It allows them to tap into funds without the pressure of immediate large lump. Some financing, on the other hand, relying on selling stock, especially in potentially large quantities, can significantly dilute the ownership stake of existing shareholders. If the company's stock price is low, they'll have to issue a lot more shares to raise the same amount of money, which can push the stock price down even further, creating a bit of a negative cycle. The fact that they needed shareholder approval to issue stock in excess of certain limits shows they are pushing the boundaries of this agreement, likely due to pressing financial needs. This strategy is typically used when traditional lending or equity offerings are difficult to secure, which could signal financial challenges or high-risk, high-reward growth plans. The key risks here are the dilution of existing shareholders and the potential signal of financial distress that this type of financing often sends to the market. However, the opportunity is clear. If Jupiter Neurosciences has a breakthrough in its research or development, this funding mechanism might just be the bridge that gets them there. It's a bet on the future success of their pipeline without knowing the specifics of their research and how close they are to commercialization. It is hard to say if this bet will pay off. But for now, it looks like they are prioritizing survival and the potential for future growth over the immediate concerns of dilution. So, what is my take? Jupiter Neurosciences is in a high stakes funding game. They've secured a lifeline that allows them to operate and pursue their scientific goals, but at a cost to existing shareholders. The success of this strategy hinges entirely on the company's ability to deliver on its promises and achieve significant milestones that will drive up its stock price and ultimately make the dilution worthwhile. It is a bold move and one that investors will be watching very closely. Alright, that is our breakdown of Jupiter Neurosciences' latest filing. What is your take on these funding strategies and what they signal for the company's future? Do you think this is a smart move or a risky gamble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.